Welcome back. I'm joined again with Bruce Griffin, the Executive Chair of Sheffield Resources. As many of you know, Sheffield entered production at the Thunderbird project in the Kimberley region of Australia with their mineral sands mine. They entered production on time and on budget. It's been 8 months since that time. Bruce, what's happened since then?
Yeah, no, it's been an interesting 8 months, Peter. I think, as you said, on time and on budget. In fact, a little bit early for production. Then as we worked through the first quarter of this year, so sort of January, February, March, we identified some mechanical, what I call fairly classic mechanical issues in a startup. We had some pumps that we had issues with and so on like that. And that did a couple of things for us. It constrained production in January. And then in February and March, we had to run at less than full throughput because we were protecting the equipment while we waited for more robust, things like pump internals and so on to come. By early April, we had all of that gear on site. We'd either already done the replacements, or in early April, on one of our dry mining unit moves, we did a refurbishment of the DMU. We replaced some gear, replaced the last of the pump internals. Since then, we've seen a really significant improvement in mining rates. We went from about 50% availability on the dry mining unit now to, it's running every day except when we're moving it, which is sort of roughly once a month. And, in the numbers we've put out today for sort of June, we've mined about 825,000 tonnes of ore, or we expect to mine about 825,000 tonnes of ore in the month of June, which is, a significant increase month on month from April, about 10%. But if we go back and compare it to where we were in March, it's more or less a doubling of where we were at that time.
Good. Obviously, I just want to touch back on, so obviously we did the quarterly webinar back in April, right, looking at that quarter. And then you started doing monthly announcements from that point, because obviously I think there was some oversize, and like you said, there was some repair work going on with the DMU, so you wanted to keep people, I guess, abreast of as to what was going on a more monthly basis, right? So in May, obviously, you had increased production. You were still ahead of where BFS results were generally predicting. Obviously, again, that didn't really go down as well as, I guess. Anyway, personally, I thought it was a pretty good update. But then we look into June now, and there's another monthly update, and you're pretty much still ahead of where you would have been at BFS. So I guess where's the concern coming from in your view?
Yeah, so I think, there was a few things. I think particularly in May, while we did have a step up in production, we did also talk a little bit about both some cost and revenue pressures we were seeing. I think, the market, part of the view would be people taking a view that would mean we would need to raise money. And, you often see this in the junior space where once people decide that you need to raise, that sort of becomes a sort of, the price is a little bit self-fulfilling. I think, we've particularly talked about a couple of things, this issue of higher oversize, which is something we flagged in the quarterly. We still see that. We've seen that sustained through. What we're obviously doing some work to understand that. Certainly don't see that as a structural issue. It's something that ultimately we believe we'll be able to make changes to address. And then we continue to see this over recovery of products. So, while the mining rate's going well, we're certainly above. We're somewhere between where we thought we would be in the second quarter and the third quarter. So you could argue, are we a half a quarter or so ahead on mine production? And actually we're in line on concentrate production. So despite that 75% and some of that commentary, we're actually where we thought we'd be on volume. So, the reaction, I think, maybe is a mixture of those things, like, perhaps some negative prior experiences for people not wanting to get caught out in that situation again, and a view that perhaps we needed to raise money.
Okay, well, let's talk about the production numbers for June, because I think this for you now is, I guess, in your mind, the floor as to where production should be moving forward, right? So
yeah, I think the way I think about it is we've seen if you think about with the updates we've done, we've basically seen month-on-month improvements. April over March. April was a part month because we only made the mods partway through it. May over April. Now June over April, and it feels very sustainable. So I would say, we would see each successive month as being the new sort of minimum performance we'd expect going forward. So certainly, I think, the way I would think about it is if people are thinking about what is, the next 12 months look like, I think it's better to think about, 12 times June rather than 4 times Q, the sort of quarterly estimates is probably more realistic about where we expect to be on production.
And what would that look like 12 months of June?
I mean, 12 months of June is just a shade under 10 million tonnes of mining.
And versus the BFS, what would that be?
Actually, for that particular FY, I don't know. But what we've always sort of said, we always targeted between 10 and 12 million tonnes a year of mining in stage one, a little bit, up and down as you often do with mining. So, 12 times June is right at the bottom end of that range. So pretty much around about where we would the minimum we would expect to maintain in stage one. And I certainly don't think, we're not done yet. We're continuing to see improvements in operations.
Okay. But I'm assuming if you're at or around sort of the lower end, you should, in theory, start being profitable, right? And I think one of the things that we should talk about is obviously one of the announcements today was that yourselves and Yansteel both put in 7.5 million into KMS. So what was the need for that if you're close to profitability?
Yeah, no, it's a good question. Look, it was really about working capital. And, one of the things, if you think about that conversation about month-on-month improvements in production, shipping always lags a little bit. And although we shipped more and we were able to do a bit of catch-up shipping this month, the reality is you are sort of building inventory that way. We also have transitioned from, particularly on our Zircon concentrate, some of our early shipments were done on the basis of prepayment, a partial prepayment. We've reverted to a more normal mineral sands, which is sort of LCs and payable, a number of, a period of time after the bill of lading is presented. What that does is it creates a bit of a hole because you've sort of been paid previously and now you've got to wait a little bit longer. So what that meant was we found in the very short term we had to fund that working capital. You have to fund the inventory on the ground. You have to fund when you pay the operating costs, you haven't necessarily received the revenues yet. So we took the view that we needed to put that 15 million in, 7.5 each, is definitely funds us for that working capital. And, the way, I think we also make a comment in the announcement that we see, or KMS is certainly forecasting being operating cash flow positive from the September quarter. That is assuming the current cost base, it's assuming current pricing, and, essentially assuming June volumes are sustained. Overall, that is a business that's generating operating cash flow. So we certainly don't see that the business that will need ongoing support for, cash support for operations.
So you're saying from the September quarter, based on June production rates and shipments at the current Zircon price, and obviously assuming the cost base that you have at the moment as well, right? So does that essentially mean that July, once the payments from June have come in, you will be essentially at an operating profit? Yeah,
what we'll start to see is, because I think, we're not, the rate of increase, we're going to be at the top of the S-curve. But what we'll start to see is that irrespective of the timing, the shipments and production each month will be, reasonably consistent, and also reasonably consistent with what you produce. You start to end up with sort of a steady state of inventory, payables, receivables, and so on. And so what we'd expect to see is that sort of cash receipts in July will include from shipments in June and so on, means that, on a sort of, I'd call it sort of on a risings basis, if you actually valued the production in the month against the cost to produce it, we're probably cash flow positive now. It's just that we've got a timing point position in June that won't be there from July onwards.
And how do these contracts work? So for example, you make a shipment tomorrow.
Yep.
how long will it actually take for you to receive payment for that?
I mean, the specific terms are always commercially confidential, but what normally happens is the way these contracts typically work is they're based on letters of credit. So what would happen is, when you've agreed with a customer that they're taking before you commit the shipment, particularly Zircon, we ship on a delivered basis, you'll agree pricing, agree a volume. They'll then present a letter of credit for that. What would normally happen is then when you have the bill of lading, you can then present that to the bank, and they will then pay out either on the terms. So there's typically a sort of something. It's weeks, not months, but it's not it's sort of that order. So typically, sort of 30 to 45 days is fairly normal
from the shipment date. From
the date of shipment, you can discount if you really want to, and normally a penalty for discounting is, right now if you look at sort of interest rates, and it's payable over a few weeks, it's a few percent, so that you always have that ability as well. But in essence, that's the way to think about it. It's sort of a 30 to 45 days after shipment is when you'd expect to receive the cash.
Good. Okay. All right. So things are moving, contrary to share price, things are moving in a pretty good direction.
Yeah.
Yeah. Okay. Good. So talk us some of the other numbers in there. So obviously you were mentioning that obviously the 75% recoveries is sort of where you're at the moment, but there is a bit of uptick in that production rates are around 75% and then recoveries are around 85, right?
So to just sort of explain that again, because I think it is a little bit, it's not that easy to sort of completely figure out. So what it is because in essence, in round numbers, we would expect about 15% oversize on average in this deposit, and we're seeing 30. Now, when you take into account undersize and all of those things, effectively that doubling of oversize means you're getting about 75% from a given ton of ore. You're getting 75% of the what we call rougher head feed, which is effectively the sand that we can feed to the plant. So that's kind of constraining plant throughput, because obviously the plant is designed for the full amount. We're effectively getting about 75%. And we can come back and talk a little bit about what we might be able to do about that. What we then find is when we put the material in the plant is actually performing very well metallurgically. It's performing, it's been like the ramp up, it's been operating at design or higher levels really right from the beginning, rather than a sort of slow ramp up. But then what we've also seen is certainly in some cases an over recovery. So we from a sort of ton of that rougher head feed we're actually ultimately recovering more tons of final product. So some people have said, is that because the grade's lower? Now, in some cases we have produced like lower ZR2, Zircon, ZRO2 being the sort of main payable content in the Zircon concentrate. But the actual payable Zircon recovery is higher. So, part of the concentration thing is a trade-off between concentration and recoveries. TiO2 we've typically seen, and the ilmenite we've actually seen higher than expected TiO2. So I think it's one of these where there is definitely an outperformance at the moment in the plant. Now, whether that is sustained if we ultimately run at full production is a question we don't know. But today, there's no particular reason not to assume that if we are operating the way we are in June, that wouldn't continue in July and August and September. So we see that as sort of a sustainable performance. Now, I think we noted in the report that over recovery slightly more on ilmenite than on Zircon, but we're already seeing, as you sort of get steadier, you can see the optimization opportunities. And that's sort of, first of all, just tuning the plant for each different level of production, and then also just seeing that maybe want to tweak the way you run the plant a little bit. And so we're starting to see those opportunities and capture them as well.
Good. Okay. And I just wanted to clarify as well, because obviously the shipment numbers that you've released for June are obviously higher than the production numbers, because obviously you had some stockpiles, you were in production before the new fall and whatnot, and obviously you've managed to do it. But Just on what we were talking about in terms of profitability and basing it on June, are we basing it on the shipments from June? Or
No,
are we basing
production.
it production. Okay, because obviously shipments are a bit of a...
So we have a bit of an over. I mean, that was, for those who might remember, we pretty much shipped, because we were able to ship zircon concentrate in bags, we pretty much shipped it as we produced. But the ilmenite, we had to wait for bulk vessels and so on. So, certainly we had built some stock, and then we had to load the first vessels and get in the swing of things. What we've found, and June was really our first chance for a bit of a catch-up month. We'll effectively have loaded 4 vessels in June, which it's not easy in the cruise season. Right now there are cruise vessels and so on in there. So, it's a time of year we wouldn't necessarily have looked to do that many shipments. So it's pleasing we have been able to.
And let's go back to this 75-85%. You mentioned remedies in there and different ways that you're potentially looking at it, because obviously it's great that the mine's profitable at the moment based on that 75-85% recoveries, right? I mean, that's a very good position to be in, and I think gives you quite a bit of safety over the next couple of years. And considering you've also based that on the sale price that you're actually achieving at the moment as well, these aren't fictitious numbers. Yeah. So, but obviously, people want as much upside as possible.
Yes,
rightly so. Yeah. What are the potential ways that you are looking at potentially getting this up to 100%?
So, I mean, the way we sort of talk about this is the first thing is you need to, the oversize, first thing you have to do is understand it. So I'm going to sound a bit like a boring engineer for a moment, but, fundamentally, to solve a problem, you have to understand the problem, because that's how you design the right solution. So there's often an instinct in this situation to say, I'll just do something. And the problem is, if you do it and it doesn't work, then you're going to do something else. But also you don't necessarily learn anything. So the approach we've taken is to understand. I think the way we think about it is that it's not just the oversize of the deposit is sort of simplistic, but it's actually how does that oversize perform through the mining, the DMU, and because ultimately it's about what can be liberated. So it's not about breaking up big rocks, but obviously this is someone has described to me as soft rock. It breaks up with a bit of water on the shaker tape, on the shaker screens. That was the idea. So one of the possibilities here is that we aren't getting the liberation that we had expected in the DMU, effectively across the shaker screens, or potentially at the screens at the plant, because we do take oversize out in a few different locations. So one of the things we're doing is actually sampling and testing those streams and seeing if there is undersized material that could be liberated from that. Now, if that's the case, one of the solutions there is potentially to change or modify the DMU flow sheet. And that could be something like extending the screens to give more residence time. You could change the size. It could be adding additional processing like a scrubber or something like that. But I think once we know that the first step is to determine if there's recoverable undersize there, then the next step is to work out what is the best way to recover that. And then ultimately, you need to be able to do that at a cost which is less than the value of the product you'll be recovering. So I think that's the process we want to work through. So that's one part. Now, the other possibility is that, the other extreme possibility is actually what it is there's actually less liberatable material than was assumed in the effectively, and therefore what you need to do is mine more material in order to keep the plant full. So the other possibility is that what you do is expand the mining capacity, make the DMU a bit bigger, and so on like that. Now, my sense is that it's probably a mixture of these things. My guess, it's very rarely one thing. It's probably a combination of liberation and the ore body. So we may find that we get some of that 25% back from making mods to the dry mining unit, and then part of it through maybe either modifying the DMU or modifying the way we operate the DMU to actually get more ore into it.
Okay, because obviously one of the things that you outlined in the quarterly, and I think it was more of a pass-in comment, but was taken seriously, was the idea of actually buying another dry mining unit, right? Is that
Look, I think it's sort of one of those things where people, I kind of used that, the way I used it was as kind of like a sizing the problem point that, a DMU is about a $20 million piece of kit. And fundamentally, if what we're needing to do is, if you needed another DMU, which if you're at 75% means you'd be at 150, which is probably a bit over the top. If you're talking about modifications, it's unlikely the modifications cost more than the DMU would. So it was kind of designed to size the problem, not that building a second DMU was the obvious solution to this, was more the thing. So I think, and why I wanted to do that was also help people understand that fundamentally you've got in round numbers, we've got a $200 million process plant and a $20 million dry mining unit. You don't want the mine to be the constraint on the process plant. So one way or another, I'm sure we will maximise value by ensuring that we keep the process plant full. And the key question for us is, what is the most economical way to do that? Yeah.
Just on the zircon market at the moment, obviously it has softened.
It's sort of...
Well, in comparison to, I guess, your FID assumptions, it softened a bit, right?
Yeah.
I guess the question is, what's the difference at the moment between operating cost and the zircon price, and how profitable is them? Because if you're making a profit at a reduced production level, it sounds like there's still a healthy margin.
Yeah, I'm probably not at the point yet where I'd say exactly what the profit margin is at these levels, but we are, we are at a, I think in round numbers, we're probably, $200 US a ton lower than circa that, somewhere between $150 and $200 a ton less than would have been assumed in the BFS. And we think we're cash flow positive we are saying we're cash flow positive at these levels. So if you add $200 a ton, that's a fairly decent thing. Now, I guess the difference is that it's not all market price weakness, which is sort of what we highlighted, was that we've seen a bit of this increased spread between premium and standard zircon, which has to do with effectively premium zircon is what the large suppliers have controlled the production of, whereas China tends to reduce a lot of standard. And then also some specific things for us about, it's the classic new product penalties that you get. New product, have to learn how to process it. The customers want to share that pain. They want to make sure that they pay for what they can get from this product, not what we believe they should be able to get.
And how does it work with the Orion debt and NAIF debt? Because one of the things that you do see, and it sounds like you're out of the woods now, but one of the things that we do see with...
I can see the edge of the woods.
You can see the edge of the woods at least. There's a bit of sunlight poking through. But one of the things that you do see sometimes, not with development projects or with sort of near-term producer or companies that have entered production recently, is they then get a bit, if ramp-up doesn't go as well, they then get overburdened with debt, and that can cause a lot of mess. What's the situation with Orion NAIF, and how does that look at the moment?
So probably the key thing for people to understand there is that one of the key features of the NAIF debt was its long tenor. So when we structured the debt was structured around a low price scenario. Effectively, you take a low case, and the fixed repayments were based on that scenario. And what happens in that world is effectively Orion payments start in June next year. So we're 12 months away from the first repayment. So we've got servicing along the way, but the first principal repayment. And there's a bit of sculpting in there, but loosely speaking, that's repaid over sort of 10 quarters. If you take the fixed repayment schedule, then the NAIF debt repays. So the NAIF debt actually is 12-year total debt, and Orion's 7 years. So you've got that sculpting. So what that means is that we didn't bake in high prices to determine the debt repayments. We baked in sort of a relatively conservative pricing. And we've got a bit of time now to build towards that point. So, I mean, you clearly, if you're in one of those situations, if you're not generating positive operating cash flow, you're always going to have a squeeze on the debt repayments, because you've got to service the debt. You'll always have some sustaining capital or whatever, right? So that's where it gets difficult.
But at the moment, so obviously at the moment you've got a 12-month buffer until you need to start worrying about that.
Yeah, correct.
And even if, say, worst case scenario, you stay at June production levels, the modifications don't work, anything else. I'm not saying that will be the case. I'd be very unlikely by the sound of it. But say that was the case, would you still be able to reservice?
I mean, certainly servicing the debt. I mean, it's a long way out, and to be able to generate sufficient cash to make those first payments, under the right, certainly as things are, we would expect that to be the case.
So going back to this $7.5 million that you've put in jointly, and obviously Yellowstone have done the same, that leaves Sheffield, based on the announcement that you released today, $10 million in cash. What does that mean for the company? And not just how long does that last, and what does it mean for your other commitments, say South Atlantic and obviously Capital Metals and things like that?
No, it's a good question. And look, one of the things that we've obviously thought a lot about is where does our priority lies and so on like that. So with knowing that we needed to put in some a relatively limited, but ultimately in terms of the scale of the project, $7.5 million each is not a massive number. In terms of our cash balance, it is a decent amount. We're looking at a corporate cost at Sheffield of about $2 million a year. So, we've got good runway. And then we have, the other things South Atlantic, we were looking at Capital Metals. Obviously we're going to slow those things down. I think Capital Metals will have confirmed that, on that basis, we're not progressing the discussions with them at the moment. We're going to put them on hold. South Atlantic, we believe we've got scope to slow down the rate of spend there. Approvals are going to take longer in Brazil anyway. So the way we sort of think about that is we've got the 10 million. We want to try and keep as much of that as we can in case we needed to provide more support to KMS. We don't anticipate needing to do that at this stage, but ultimately you never know what the future holds. So we need to have some buffer there.
Okay, so in theory you could last another year and commit another 7.5 million and still be okay, essentially.
Yeah, I mean, roughly speaking. And I think, obviously we'll be looking and I think the commitments on other things is an interesting one. I mean, we've already paid for the option in Brazil. So, it is an option. We're not obliged to put any more money in. Yeah, we have a very good partner there. We've got a common understanding of the money that's actually required. So I think, ultimately, if we have to, we will, we'll keep the money and use it for KMS.
Yeah, but obviously it's a bit of a sensitive moment at the moment because obviously it's just, you've just had to do it and whatnot. But I guess the main thing is if what you're saying translate into reality in terms of the profitability at the operating level, then potentially down the line you can relook at.
Oh, correct. And look, certainly we don't see that, we haven't started it in Capital Metals, so it made sense to put that on hold. Brazil, we're there. The money we've put in is still being spent. We'll make a decision on what happens next there when we have to make it. But what I mean, and look, to be perfectly honest, it's not unrelated thing. Our shares at 30 cents. Are we going to issue a bunch of capital at 25 cents to fund things other than Thunderbird? No. So we've taken the view. Certainly as things stand at the moment, I've just said, we can cover the corporate cost. We don't feel an urgent need to raise money, and certainly not at these prices. So, we believe we can manage through till the end of next year would be the kind of time frame we originally anticipated. The first potential cash flows coming back from KMS to the shareholders, and that's always been our approach, is try and have enough cash to see ourselves through till the end of calendar year 25.
If you did nothing else, if you're saying there's a $2 million per annum that you spend at Sheffield, that you're good for 5 years,
that, right? So so we've got. I mean, our view is that we still have some capacity in what we've got, but obviously, we would like, there's a difference between today when I'm saying we will be operating cash flow positive in September and perhaps in 3 or 4 months' time when we've shown that. Again, so over time, our confidence and the confidence of others that we're actually going to generate that cash will go up. So in the meantime, we've got that buffer.
Yeah, it is a show me, not a tell me market. So
Definitely. And I think, look, mineral sands is a show me, not a tell me commodity. So,
yeah. Good. Okay. So other than that, what else can we be looking out for over the next couple of months? Obviously, we've got quarterlies coming out soon. And
quarterly in sort of, I guess, 3rd or 4th week of July. We have been doing these monthly updates. I think the approach we took was where there have been if there's a material change, we think it's appropriate to update the market. Clearly, the progress in mining that we saw, as we've seen month on month, April over May, May over April, June over May, and so on. Whether we continue to do monthly updates will really depend on, what's happening. And we may do them initially just to show that things are continuing as expected. So I think the way I would want people to think about it is that, we're still going to focus on the quarterlies as being really the right time frame for operational updates. But if there are material changes in between, then we're going to use the interim updates to make sure people stay fully informed about what's going on at Thunderbird.
Good. Bruce, thank you for your time.
Cheers. Thank you, Peter.